Now, just as the investor sentiment shifts back to bearishness, equity exposure is being reduced. We talked about breadth metrics signaling strong participation, but here's the thing: the S&P 500 is starting its best short-term seasonal stretch when you look at historical trends. So the sell in May and go away, that's a 6-month period that concludes with the start of November. So we're now entering a favorable 6-month stretch. But on a shorter term basis, when you look at 3-month forward returns, last week marks the start of the best 3-month period for the S&P 500 when you look at data going back to 1928. That's what this red line on here tracks. This is tracking, from this point in time, what the 3-month forward return in the S&P 500 looks like, and you can see we're near the highest levels on the year. So we've been approaching this level here over this past week or so, and so we're in this sweet spot for seasonality at a time when we're seeing evidence that the economy is growing. There's bearish investor sentiment, which is a contrarian indicator, and we're seeing strong breadth as well. So all these things just coming together at the same time, that you're entering a very strong seasonal stretch for the S&P 500.